in that industry, and is actually a professional and expert on the subject matter. Before I bring him to have the floor, let me quickly introduce him to you through his profile. Dr. Olorundare Kehinde Joseph, PhD FCA, has over 23 years hands-on experience in the insurance industry of Nigeria. He began his career as an executive assistant at Industrial and General Insurance Company Limited 2002, and later worked as the financial reporting accountant at Cornerstone Insurance PLC and UBA Insurance Company Limited. He is currently the Chief Financial Officer of Heirs General Insurance, AGI, a subsidiary of Heirs Holding, a Pan-African investment group with presence in 24 countries and 4 continents. He has functioned in several senior management roles in finance, including financial controller and group head financial reporting, performance management, and business intelligence at I hope you can hear me.
Yes, you just came back. You just came back now.
Please, can you hear me?
Yeah.
Yes, now. You can hear you now.
Continue.
Prior to joining Heirs General Insurance, Dr. Kehinde was the Chief Financial Officer. Yeah, I was muted. He was the Chief Financial Officer of Cornerstone Insurance PLC, where he handled the entire finance function, including financial reporting, performance management, taxation, strategy formulation, and implementation. In his capacity as CFO of Cornerstone Insurance, he was also responsible for the treasury and investment arm of the business and the administration departments. Dr. Kehinde holds a bachelor's and master's degree in accounting from University of Lagos, as well as doctorate degree in accounting from Babcock University, Ilishan. He's a senior member of Chartered Insurance Institute of Nigeria, CIN, and also a fellow of the Institute of Chartered Accountants of Nigeria. Is an FCA. So please welcome with me as I hand over the session to our speaker, Dr. Kehinde Olorundare, as he takes us on the subject matter of insurance investments, understanding the complexities in accounting, disclosure, and valuation. Thank you. Doctor, over to you.
Yes, thank you very much, Mr. Oshulano. Good afternoon, our district chairman, and Dr. Sam. Good afternoon, ESCO members, and good afternoon, ladies and gentlemen. I want to thank you for the opportunity given to me to come and speak to you this afternoon. I don't know, can you see my slide now?
Yes, you can see it.
Okay, good. So our topic today, as mentioned by our technical secretary, we want to understand the complexities in accounting, insurance accounting, the disclosures and evaluation. So when you look at this topic, it suggests that the audience, at the end of this session, we like to understand insurance accounting. We like to know the disclosures and the valuations that are common in insurance accounting. And I think I have done my best to make sure that is covered, and that at the end of this session, our audience will be able to have a better appreciation of insurance accounting. This is the table of content. We'll just be looking at it under the subheading that we are seeing on the screen now. So, nature of insurance business. When you look at that topic, the topic suggests that insurance accounting is a complex one, and that is correct. I allude to that fact that insurance accounting is complex. So no, it's not surprising that the topic say the complexity of insurance accounting. And why is it complex? We'll see that as we go. If we're looking at the screen before me, so when people mention insurance business, these are the kind of things that should come to our mind. So on the first picture, you can see fire raging, and then the carcass of the fire after it has burnt. Actually, this is a picture of a palisade in Los Angeles, where a very large community got burnt down this year. And the estimates that they put the loss at is about $35 billion if they are going to replace that. You can imagine that kind of loss. You can also see flood, and then see what we call annuity that caters for retirement, and that's the future. We also see on the right side the life, the health, the car insurance, which is also known as motor insurance, travel, and other liability. So when you talk of insurance, what comes to your mind is indemnity of losses. So that's what we are selling. We sell a promise. Insurance is promising the insured to indemnify when a loss occurs. So this established that it's a very separate kind of business. It's different from other kind of business that we know. The regular business that we know is about goods and services, where you either render service and you get paid, or you sell a product to somebody and then in exchange for the product, you collect your money. So insurance is not like that. So we quickly jump in. What is insurance about? It's important that we understand what the business itself is all about for us to be able to appreciate why the accounting is different and why the complexities, and then we can understand the complexities better. So I will just take a little time to paint, to establish the background of the nature of insurance business to us. So when you're talking of insurance business, it's about risk transfer. The insured, some of us may be familiar with the definition of insurance contract. We've had it several times. That is a contract between two parties, one the insured and the insurer, whereby the insurer undertake to indemnify the insured against a future loss upon the payment of a consideration known as premium. So that is the nature of that contract. Now, what does that mean? The simple definition I just made now, it simply means the insured is transferring his risk to the insurer. Then a question may happen to some people's mind that what if I don't have risk? There is nobody that does not have risk in life. That is just the truth. Even if you are alive, you are faced with the risk of death, and that's why there is life insurance. Even to the man that has nothing, he is faced with the risk of death. He can be involved in accidents, and then a permanent loss can happen. Leg can get broken, arms, and things like that, which is covered by permanent disability insurance. So everybody have risk. If you have a car, you have a house, you have furniture, you have whatever so there is nothing you're doing in life that does not have one form of risk or the other. So therefore, insurance helps you to take your risk. You can transfer your risk to insurer. And of course, in exchange for premium, also insurance is about uncertainty. So the future is not certain. And that's why it's important to take that step today to ensure whatever risk you have, your properties, your business, many things, is important because it's about the future. Look at the definition I made. It is about the future. So you cannot come and insure a loss that has already happened. That's fraud. Insurance does not cover that. Another thing I want us to know is that insurance is about pooling of risk. So some of us may be wondering, how come I give somebody 1 million naira for an asset that is worth 50 million, and is promising me that if anything happened to that asset of 50 million, he's going to pay me 50 million. It's not magic, and it's not fraud. It's not CBS scheme, as it happened recently. It's not a Ponzi scheme. It's a real business, and there is science to it. What is the science? It's the pooling of risk. So if I collect 1 million from about 1,000 people, or even more than that. I think there's a feedback from someone. So it involves pooling of risk. I mean, if I collect the 1 million I just mentioned, if I collect it from up to 1,000, 10,000 people, then it becomes billions in my hand. Now that billions will be more than enough to cater for those those who will suffer loss during the year. And so it's about pooling of risk. Of course, it's also about financial protection, because whatever loss people suffer, it boils down to financial protection. Even if somebody dies and a life is lost, you want to ask, does that mean you can restore the life? No. But there are people that will suffer as a result of loss of that person's life, especially where the person is a provider, a breadwinner, is responsible for funding one or two things, or even maybe a borrower that has borrowed money from the bank. So that's why insurance have credit risk. So there are people that will suffer loss as a result of that person's life. Then insurance will provide financial protection. It's also a long-term contract. So apart from the general business, when you go to life, annuity, for instance, is for a very long time. It can run for 15, 20, even 30 years. There are other products like that too. And then I mentioned earlier, the policy holder is a party to insurance contract. It's also about risk management. And then indemnity principle, I mentioned earlier, is about indemnifying insured against losses. When you suffer loss, that is when you can actually know the benefit of your insurance policy that you have bought, or your insurance contract. Where there is no loss, insurance may look very, very ordinary, where somebody have not suffered loss. But again, I mentioned earlier there is a pool, and inside the pool, the probability that one or two or more person will suffer loss is almost certain out of that pool. So it is a few that suffer losses that will be indemnified using the fund that has been pulled from every other policy holder. So that is the background of insurance contracts, and we quickly move into the meat proper. So when you talk of insurance accounting, it's clear now that it's different from other business. Insurance is not about selling a product or a service. It's about selling a promise. It's about selling indemnity. So once it's about that, then it's easy for us to process it in our mind that the nature of accounting for that kind of business will certainly be different from other conventional business that involve exchange of goods and services. Now, when you look at a typical insurance account, what do you see? Do you see the kind of terms I will begin to talk about now? And it's important we understand some of those things. They are not as straightforward as what we understand in the conventional business. So, but when you pick insurance financial statement, you will begin to see the terms that I will begin to explain to us now. And focus on the terms that are peculiar to insurance accounting. So when you see other, when you see a full insurance accounting, you may see other lines that are not covered in this presentation, because we want to focus on what is peculiar to insurance. The focus is on insurance. So if there are, for instance, management expenses, you will find it on the account of any business. Investment income. So things like that are being excluded here. So insurance service revenue. So that is how insurance report our own revenue. And what is it? It is the portion of our premium that has been earned during the reporting period. Some of us that are not maybe familiar with insurance business, you will pardon me. Some of these terminologies can only be explained the best way I'm explaining them. And somebody that is not familiar with insurance may find it a bit complex or difficult to interpret what I'm saying. But I believe Maybe during question and answer, then we can throw more light where it is probably not clear. So insurance revenue is recognized based on the portion that has been earned in that year. Insurance premium is earned on time apportionment basis. It's run off over the period of the risk. So if you give me your car to insure today, it's since January, and you pay me premium for 1 year, as at April, I can only recognize 4 months out of the premium you have given me. Take for example, if the premium you pay me is 12 million in January, and that 12 million is meant to cover the whole year, then it means by this April, I will report 4 million naira as my revenue. Now, that is for general business. It's quite straightforward. When you're looking at life, general business is also known as non-life. In life insurance, it's a bit different. There are models and estimates and valuation used to recognize revenue, especially for long-term business like annuity and investment-related products. So there are actuarial valuation models that are used to value those ones. We will talk briefly about some of them as we move on. I am not an actuary, so I will not go deep into it. Also, we have what we call insurance service expenses. So that's the revenue mentioned. Insurance service expenses include what we call claims. Claims is when the insured suffer loss and then he filed the claim with the insurer. The insurer is under obligation to pay to settle that claim to the insured. So that is an expenses to us. We also have what we call a brokerage commission. We have what we call underwriting expenses. Underwriting expenses involve brokerage commission, amortization of acquisition cash flow. We also have attributable management expenses. So the way insurance work is that under conventional business, you recognize your management expenses as a bulk, but insurance accounting is divided into two. There is insurance contract part and there is non-insurance contract part. So your management expenses, you must recognize a part of it and add it to what we call insurance service expenses. And that is what is referred to as other directly attributable expenses. It involves your salaries, your operating expenses like traveling, power, telephone, advertisement, and all these are there. Luckily, I mean, thank God all of us are accountants, so at least it is assumed that there is that foundational knowledge of accounting generally for all of us. Then the net insurance, reinsurance expenses. What is reinsurance expenses is when an insurance company also buy insurance cover from another insurer called reinsurer. That's where the word reinsurance comes in. Mr. A insurance company cover the risk of Mr. B, who is the insured. But Mr. A observed that the risk is too much for him to carry alone. What does he do? He go and buy additional protection from a reinsurer. That is an expense because it is from the premium he collected from Mr. B that is going to settle Mr. C, who is the reinsurer. Then we have net finance expenses or income from reinsurance, from insurance or reinsurance contract issued. What does it mean? In insurance, you cater for what we call the changes in time value of money. So 1 million naira in January is not 1 million naira today. In insurance, you will account for that. Now, the question that may come to our mind is, how do you account for that? Or you use various valuation model, actuarial model. But one very easy example for all of us to identify is if you do business in dollar in January and you collected, say, $5 million or $10 million. So as at 1st of January, I think we have 1,535. So for $1 million, that gives you 1.5 billion naira. As at today, is around 1,600. Let's assume it's 1,600 naira to a dollar. It means that 1 million is now 1.6 billion. Now that changes. Yes, some of us will call it exchange gain or exchange loss. Yes, you are correct. But in insurance, as long as it relates to insurance contract, you will report it under net finance expenses or net finance income. That's where you are going to report it in insurance accounting. But of course, in a conventional business, you just take it to your exchange gain. Does that mean we don't recognize exchange gain? We recognize also if it is not related to insurance contract. Yes, we recognize it as exchange gain. But if it relates to insurance contracts in any way, either on insurance asset or insurance liability, we will recognize it under this line. And then we have what we call contractual service margin. Is the unearned profit. In insurance accounting, I'm actually looking at the time so that I don't overrun my time. In insurance business, we have what we call onerous tests. Some of us will be familiar with on IFRS 17. That is the standard that govern how you report insurance contracts. The financial reporting of insurance contract, that is the standard that govern it. So there is what we call onerous test. It's expected that we test onerosity of every contract that you receive in insurance. And what does that mean? You want to test whether the premium that you have received is enough to cover all your obligation in fulfilling that contract. Now, if the premium is enough and there is surplus, that means you make gain. It's a profitable contract. If it is not, then you are making loss. What fall under this category is majorly the long-term business. A very easy example I can make for us is you sell an annuity today, and the annuitant is 60-year-old. He bring 100 million naira to you, and you promise that you'll be paying the annuitant, say 1 million naira every month. So that means every year you'll be paying that annuitant 12 million naira. 12 million naira means you will be paying 12.5% of that 100, 12% of the 100 million every year. The guy may live for 30 years, he may live for 20 years, he may live for 25 years. So you are going to project into the future. And of course, it's expected that you go and invest that 100 million. So let's say you invest 100 million in a bond that is returning 14% for you every year. Of course, it's expected that you will invest in assets that will yield return that will cover your obligation. So that is where you say is profitable. Then that profit, you will not recognize it in your P&L immediately. You will create a liability account called contractual service margin. And then you will put it inside that contractual service margin account. And then over the period of that contract, you will be earning the portion that relate to your reporting period. And then that is what you'll be recognizing as profit in your P&L or P or L. That is in your income statement. So that's how contractual service margin works. What I have just, this slide cover mainly the income statement of insurance accounting. That is what you find there that are peculiar to insurance that you are not going to find on any other form of account in any sector. Here, majorly relates to the statement of financial position, which we also call a balance sheet. Liability for remaining coverage. What do we call it? Is the unearned premium. It's similar to what I explained earlier, the contractual service margin. Just that this relates to short-term contracts that are usually 1 year or below. Then you use LRC. Where it's a long-term contract, you use the contractual service margin. But the two of them have a liability account holding practically the unearned portion of your premium. So I think that's the basic explanation. And if I may refer to the example I used earlier, the 12 million naira premium that have been collected for 1 year. Now, I say as at April, I have only earned 4 million of that 12 million. So it therefore means I still have 8 million naira that I have not earned. So as at April, my liability for remaining coverage will be 8 million. So I will carry liability in my account as 8 million naira because I have that part of the obligation that I'm here to fulfill to the insured. Also, we have what we call liability for incurred claims. What do we call that? When your insured suffer loss and then they notify you of the loss, usually there will be an estimate of loss that will be submitted to the insurance company. What the insurance company first do is to recognize that liability, create an expenses, that is debit your P&L, and then credit your liability, which is your balance sheet. When you settle that claim, what do? You credit your bank and then eliminate the liability by debiting it. However, when it is yet to be settled, you have a liability, so you carry it in your books. Now, some of us may want to ask, is it just only the estimate that is submitted by the insured? Yes, the estimate first. On top of the estimate, we have what we call IBNR that will be added. IBNR simply means incurred but not reported. The concept behind IBNR is that in insurance contract, you may have policy holders that have suffered loss, but they are yet to communicate that loss to you. Okay, as we are speaking now, my company have vehicles that they have insured that are probably on the road now. Some traveling between Lagos, Ibadan, between Osogbo and Ife, and between Abuja and Kaduna, and so on. Anything can happen. Now, if it happens, chances are that we may not be notified immediately. So IBNR covers that portion. On top of IBNR, you will also do what we call risk adjustment factor. Risk adjustment factor is to recognize other risks that are peculiar to your business environment, to your past trends. Under IFRS 17, you have provision for that. You will also add it. Usually, it ranges between 10% or 6% of your gross liability. So you also have that. And then we have what we call asset for remaining coverage. Don't forget that I've mentioned these are only balance sheet items that are peculiar to insurance. So some of us may want to be asking, so where is the bank cash and cash equivalent? Where is the financial asset? Where is the PPE? All those ones are not covered here. It is assumed that the focus of this audience is to learn about insurance accounting. So we leave out non-insurance matter. Asset for remaining coverage. This is the reinsurance portion that have not been amortized. It's just the opposite of LRC. LRC, like liability for remaining coverage. ARC, asset for remaining coverage. What does that mean? When an insurance company reinsures its risk, then it means the portion that have not been amortized will be carried as asset. The same thing for assets for incurred claims is the other part of LIC. LIC, liability for incurred claim. AIC, asset for incurred claims. Now, some of us may be familiar with insurance account before IFRS 17, which is under IFRS 4. So we may be looking at how come most of these terminologies have changed. These are IFRS 17 terminologies. They don't exist under IFRS 4, but largely the description of those items are the same so that we are not confused. And because IFRS 4 is gone and gone for good, so we need to use IFRS 17 terminologies so that we can be in tune with the current trend. What do we call coverage period in insurance? Every insurance has coverage period. So let's say maybe for annuity, and even annuity too has coverage period. When the insured dies, then the policy lapses. Except when the insured die before, even if it died before 10 years, the policy have lapses, only that there may be refund to the named beneficiary of the insured. We also have what we call investment component in insurance, where you don't want to buy indemnity. You don't want us to indemnify you. You just want to save towards a particular target. You want to save towards the funding of your child education. You want to save towards maybe to raise part funding for your building in 5 or 10 years time. Those are products that fall under investment components, and they are also carried as liability in insurance books, of course valued with many different kind of actuarial model. We quickly go to what are the basic things that make insurance business to insurance accounting to be complex and to also be different from other conventional business we know. The first one is the revenue recognition. As mentioned earlier, it is not straightforward. For instance, if I buy a product, I will just determine my margin. I know how much I buy the product. I know my cost of purchase. So if my cost of purchase is 1 million naira, I ask myself, how much margin do I want? Or what margin is competitive? If it is 10% or 20%, I simply mark it up. And then I will label the price 1.2 million because my margin is 20%. So 20% of 1 million is 200,000. 200,000 plus 1 million gives 1.2. It's easy to determine your price. Also, in service rendering, you can calculate your cost of transportation, the man hour you spend. Maybe it involve you to stay in hotel, or you use some material in rendering that service. You will cost all this material and then build a premium on it, or a margin, and charge the price. You ask yourself, these insurance people, how do they even calculate the premium that they charge? I mean, your guess is as good as mine. It's a complex process. It is. Because you ask me, how do you give me a car of 50 million naira and I'm charging you premium of 1 million naira? How do I cover my cost? So there are models that are used, actuarial model that are used to calculate this premium. You look at what is your past experience. What are the kind of losses you have incurred? If I have 1,000 policy holders, will it be able to take me to the break-even point? So if I'm charging 5% on motor insurance, with that 5%, will I be able to break even? Let's say I even insure just 1,000 people. So, but this one is not straightforward like adding a margin. It involves some complex statistical calculation. So that is one big difference in determining your pricing in insurance. Also, liability valuation. So you have somebody give you 100 million today, and you're going to be paying that person 12 million naira every year for, let's assume, 30 years 30 years mortality table. So from 60, you're assuming you guys will live for 90. That means you'll be paying 12 million naira every year for the next 30 years. So when you look at 12 times 30, we're talking about 360 million naira. And hello, the guy only give you 100 million. How do you value that? That means you have a liability, a future liability of 360 million naira in your hand. How do you value that? You need to discount the future value of that liability to present value. So it is the present value you will put in your books. Now, yes, some of us will say, that's management accounting or cost accounting. It's not as straightforward as the cost accounting or the management accounting that we are familiar with. So apart from that discounting of the future value, there are other variables that you must consider in doing the liability valuation. Actuary are very good at this, and that's why you see most of the time insurance company rely on actuary to do their liability valuation, because what you are trying to do is to determine a future value today, and future is not certain. So, and what that means is that even what the actuary are doing too is an estimate, because it's about the future. It's not starting. Accounting is generally based on historical cost concept. But now somebody is asking you to determine a future value and put it in your books. So you see that is different from the conventional accounting concept of historical costs that we are familiar with. Also, there is what we call asset liability matching in insurance accounting. What does it mean? You match your cash flow from your investment. Investment means the asset that you have created with the premium you collected. You must match it with your liability. The example I made earlier, somebody give you 100 million to buy annuity, a retiree. He just collected his retirement benefit and he gave it to you as an insurance company. He said, sell me annuity. I'll be drawing 1 million or 2 million naira, depending on the bargain, every month. Somebody drawing 2 million naira every month means you pay 24 million naira at the end of the year. You must go and look for assets that will also generate minimum of 24 million naira for you every year to be able to fulfill that obligation. If you have that asset mismatch, the company can go down very soon. And what that means is that the fund of the retiree will be at risk. And that's why the regulatory provision around insurance is very, very stiff and very, very complex. There are a lot of regulation, and that is the next point that I'm making. Insurance companies are subject to strict regulatory requirements and solvency capital requirements, which don't apply to most regular business. I mean, if you're a business and you make money, you may generate profit of 4 billion. You can just tell your management, let's buy a bond of 5 years. Let's buy bond of 2 years. Let's buy treasury bill of 12 months. And you put it in your books. You're not worried about any liability. You can't do that in insurance. The example of annuity I make, you must go and look for bond of 20, 25, 30 years so that you also have a long-term asset that will cover that liability. And I mean, if you will see some of the regulatory requirements for insurance, they are quite many. And it's God that is helping insurance company to fulfill most of these regulatory requirements. Insurance is also about risk management. Yes, you can say other conventional business also have risk. For instance, if you are talking of finance risk, credit risk, liquidity risk, price fluctuation risk, exchange rate volatility risk, interest rate risk, yes, all businesses are exposed to that. But beyond that, insurance is also exposed to all those risks I mentioned. Those are not even the risk that are the headache of insurance company. The other risks are real risk of real loss in the real world. So all those things make insurance accounting to be very complex. It creates inherent complexity in insurance accounting, because when you look at all the things I just described, all the things I just explained, I mean, in your mind, if you have never worked in insurance company, in insurance account department, you'll be asking yourself, what are they even doing? How are they even doing this thing? And at time, even
The order has gone.
Go ahead, doctor.
We can't hear him again. You know. Maybe it's his network.
Doctor, Olorundare, are you back? I think it's network. Okay, why waiting for the presenter? While waiting for the presenter, we can be dropping our questions in the chat box.
Hello, sir.
Hello? Mr. Olubadu?
Chairman,
Mr.
sir. Chairman.
Yeah,
Chairman,
can
sir.
you reach out to him? Let us
Yes, I'm
have
trying
the
to reach him.
questions. Yeah, let us have the question in the chat box, then we read it out to him so that we can conclude on the section. Sorry for the break in transmission. I think it should be on now.
Sorry, professional colleagues is trying to log in again.
I'm sorry. NEPA took light in my house and the Wi-Fi just disconnected temporarily before before the inverter could pick it. Sorry about that. Are
You are
you?
welcome, doctor. There's no problem. You are welcome. Let us continue and then you can wrap it up soon so that
Yes.
we can entertain
I'm
question
about to
and
round
answer.
up now. I don't know. It seems we stop at the challenges, right?
Yes.
Okay. So, how do you manage the challenge? I mean, accurate record review. So I will just focus more on the last item because almost every company have all these regular review and update, implement robust internal control, stay abreast of regulatory changes, continuous training and learning. Very, very important. And people have even left the word training now because people go to for training at times and they don't learn anything. So the emphasis now is on learning. Learning. Make sure you learn and continue to learn. There is nothing that is not learnable. That is how to overcome the challenge. These are the kind of regulatory all kind of laws that insurance company are expected to comply with in the country. You can see these are even the ones that came to my mind while preparing for this thing. There are other laws that are not here. Just one sector having to comply with all these laws. This is the illustrative financial statement. I don't want to share the account of any particular company because especially when I don't have permission to display it publicly. So that's why I just use this illustrative financial statement. But this is what the balance sheet look like. You can go to the website of any insurance company, download their accounts, and this is what it looks like. You will see the insurance contract assets that I mentioned earlier. That is the ARC and the AIC. And you see insurance contract liability and investment contract liability. These are the LRC that I mentioned earlier and the LIC. And then this is the income statement. So you can see insurance revenue, insurance service expenses, net expenses from reinsurance contract, and then net finance expenses from insurance contract, net finance income from reinsurance contract. So you will find all those things on the insurance account. So in conclusion, as I've been mentioning earlier, insurance accounting is different from regular conventional business accounting. So therefore, that nature makes it to also be complex. And to understand insurance accounting is very important to possess all those specialized skills so that you can understand it very well. And when you are reading some of the financial statement, you understand the build up to how they arrive at the PBT and some of those asset and liability in the account. Thank you very much for your time.
Thank you so much, Doctor. We appreciate your session as you have taken it. Everything you have said actually displayed that you are an authority in that industry. Thank you so much. This, you have brought us closer to the industry, especially the area of understanding the terminologies used. And sorry, I'll be muted again by the general whatever. Okay, so let's go into the session of question and answers. So please, if you have questions for Dr. Kehinde, please, can you indicate if you have questions for our speaker? This time for questions, please. Okay. I can see just one person, Tolu. Any other person? Okay, Tolu. Let's start with you.
Good afternoon. Good afternoon / evening to everybody. Thank you very much for the presentation, my doctor, and all protocols duly observed and duly greeted. So my question is that, like, for the financials of a company, I understand that one of the qualities is understandability. Um, the stakeholder should be able to understand, or whoever is reading the financial should be able to understand. So, like, I saw the financials that for the insurance company that you actually showed us for the prototype or a template for it, and the understandability is not really there. So I wanted to ask, is there a reason why it isn't really understand? Is there a way accountants, people like us that are supposed to be able to interpret or understand financial statements at a glance, can like go about that? Thank you.
Okay, Doctor, please, before you respond to that, let's take the next question from another doctor. Dr. Peter, please, you have the floor. Quickly ask your questions so that our speaker can respond to all the questions at the same time. Thank you.
Thank you. I want to appreciate Dr. Kennedy for this well-taught discourse. My question is on the area of health insurance. I want to know how IFRS 17 deals with health insurance in the midst of general insurance and life insurance in terms of insurance account. Thank you.
Okay, thank you very much. Okay, would that be all? Can we take it?
Yes, you can respond, sir.
Okay. I wish I can share that account again. So, in terms of understandability, I agree with you that is very important to understand insurance account. And if you look at the template I share, I believe exactly. Let's go to that. Let's go to that exactly. Yeah, good. So when you look at it, the only area where it is different from financial statement of conventional business is just those lines that relate to insurance and how you measure those lines. How do you derive the numbers that come into those lines? Every other thing is the same. It's pretty the same. So if you look at this balance sheet that is being displayed here now, I mean, statement of financial position, you see cash and cash equivalent, statutory deposit. Yes, for any industry that has a regulator that mandate them to deposit with the regulator, like bank also have statutory deposit. Financial assets, property and equipment, right of use of assets, investment property, deferred tax assets. These are regular things you find in financial statements of many companies. But of course, you're not going to find insurance contract assets, reinsurance contract assets. You are not going to find insurance contract liability, investment contract liability. And that is the essence of this session, that we all recognize the fact that those things are not that straightforward. But I mean, to the extent that you have it in the financial statement, you can understand it either as an asset or as a liability. What you may not understand is that how did they derive it? So if you're an accountant and you want to dig deeper, then at that point, you may need an expert in that line to take you further. The same thing, if we look at the income statement, so there are other lines that you will find in conventional financial statement. You find revenue. Other company, you will see gross earnings. You will see gross revenue. You see things like that is also our own insurance revenue. So just juxtapose it where you see gross earning or revenue, total revenue. Just take it as insurance revenue also. And then our expenses, we also broken down earlier that is where the difference is. So, for instance, the insurance contract service expenses, I explained earlier in one of these slides, things like claim, things like acquisition expenses, you don't find them in conventional financial statement, but you definitely find them here. And that is what make this different and peculiar from other conventional financial statements. I hope that satisfies you. Tolulope.
Yes, sir. Thank you very much, sir.
Okay, for Dr. Peter, whether IFRS 17 apply to health insurance, and then the difference between health insurance and life insurance. Well, the standard is principle based and it applies to transaction. So once the transaction you are doing qualify as insurance contract, you are expected to apply IFRS 17, even if you are not an insurance company. So if the business you are doing qualify for if you read the accounting standard now, a contract between two parties whereby one party undertake to indemnify the other party upon the payment of, payment of future loss, upon the payment of indemnity for a future loss after receiving premium. Now, if you have all those ingredients, is the transaction futuristic? Is there a payment of premium? Is it contingent upon the occurrence of a loss? If those ingredients are there is an insurance contract. You must apply IFRS 17 on it, whether you are an insurance company or not. I hope that satisfies you, sir.
Yes, thank you. Thank you, Dr. Ken.
Okay, I think there's also a question on the chat box. I don't know, moderator, if I can take them.
Yes, please, you can take them.
Okay, so the first one is on VAT. Yes, that is Smith Oluwatobi Abidemi. He said, how did the insurance company account for VAT, assuming the VAT has been removed by the broker? So it's an expenses. Yes, you are very correct. Commission is a fee and it attracts VAT. It's an income that attracts VAT under our VAT law in Nigeria. Commission is an income to the broker and is an expenses to the insurance company. So when broker want to remit premium, actually we are supposed to charge the broker. But another peculiarity of insurance company, the broker deduct it. Of course, because the broker is also expected to pay withholding tax on that commission. So in order not to have a double whammy, so it's pushed to insurance company and we bear it. So it's not a problem. Is that we account for it as expenses in insurance company. It's part of our expenses. Also, we have another question. Is there accounting software for insurance accounting like other regular business like SAP, Sage Zero? Yes, there is. There is insurance accounting software that are specifically designed for insurance accounting. So we have what we call what I use in my company, Escadenia. Another one is called AIMS. There is many application in the market that is designed for underwriting. You can do underwriting and then from underwriting, process transaction to your accounting ledger. So yes, the answer is there is. Also, I think that looks at that seems to be everything. Okay, how is investment insurance accounting treated? Our investment follow the regular treatment. Most of the investment transaction fall under financial assets. We invest like any other regular thing in the investment market, like bond, short-term placement, treasury bills, quoted equity, real estate. Those are where we also invest. So the way we account for it is not different from the way any insurance company will account for it. Any conventional business account for it, because there are standards that guide them, like IFRS 9 and other standards like that guide the financial assets. So that's what we also follow. However, plus those IFRS 9 standard that we must follow. There are other regulations that govern what we can invest in, the proportion of what we can invest, and then so there are other do's and don'ts that govern our own investment, but it doesn't affect the accounting. That's the way I will answer that. Then
I don't think there's any other question.
yes, that's all.
Okay, thank you so much. Thank you so much for those responses. You are well appreciated, sir. Let me hand over the session back to Chairman and the General Secretary as they help me to handle the area of recognition of our speaker for this session. Thank you, sir.
Okay, thank you very much. Dr. Ken Deolorun, the FCA.
Thank you, sir.
The CFO of IAS Insurance. We really appreciate you. Distinguished members and professional colleagues. This is a wonderful section. And on behalf of the Ican in Ilupeju District, we want to express our gratitude to our distinguished speaker, Dr. Ken Deolorun, FCA, for the excellent delivery of today's technical session on insurance investment and understanding the complexities in the accounting, disclosure, and valuation. Doctor, your depth of knowledge, clarity of explanation, and practical insight have truly broadened our understanding of this critical area of our profession. Not everybody wants to dabble into insurance accounting and even taxation. We call it a special area. You have not only simplified the complex matters, but have also challenged us to stay updated and proactive in our various professional engagements. We deeply appreciate the time you have spent with us. And it's clear that the knowledge you have imparted, you have a lasting impact on us. As a token of our appreciation, we like to present to you a flag of honor. Do we have it? Okay, you are okay. It has been displayed. Fine.
Yes.
This will
much,
be, sir. We will send it via courier to you. This is not a cash. This is a symbol of gratitude and recognition for your outstanding contribution to today's meeting and technical session, to the continuous professional development for our members. Once again, thank you, Dr. Ken Deolorun, FCA. We look forward to more opportunity to learn from your wealth of experience in the future.
Thank you, sir.
We will definitely call on you, and we are offering you our membership too. We want you to join us. So thank you all, and God bless.
Amen. Thank you very much, sir.
Yeah.
I'll take my exit now.
Thanks so much.
Thank you.
Thank you, Chairman, sir.
Yeah. We can produce. Okay, can we? General Secretary, what do we have now? Can we continue with the meeting and close up the meeting, right?
Yes, my chairman, thank you very much. We can just have, if there are other members joining us for the first time that have not introduced themselves. Kindly signify now. We proceed to any other business. If there are comments, questions from members before we move to the closing and adjournment.